So everyone's really expecting a quarter point interest rate increase. That's been well telegraphed by a variety of Fed officials. So it seems like, we're going to get this step down once again from the pretty large interest rate increases that have, come to be a common occurrence just in the last year or so from the Fed. But we're now returning to a more normal cadence of interest rate tightening. But I think the kind of more interesting aspect of tomorrow's meeting and rate decision is really going to be, what the Fed signals about what's coming next. So how many more 25 basis point interest rate increases can we expect, this year? How close is the Fed to wrapping up what has become, one of the most aggressive campaigns in its history to raise interest rates? Have they softened their view at all on the terminal rate needing to rise above 5% for no cuts, to be in play for the entirety of the year? And how they're really taking in all this additional economic data that we've received in the intermeeting period, which shows, a more mixed picture. We don't yet have this cohesive story of a weakening economy, but we're getting quite close to that. And so it'd be interesting to see kind of what they're taking in and how they're kind of digesting all this new information and then what it then means for, the policy path forward. So in terms of, specifically the way in which they're going to be signaling some of this, we're obviously going to be hearing from Chair Powell at 2:30 in the press conference, as you mentioned, but everyone's going to be dissecting around 2 p.m. The policy statement that's going to come alongside the rate decision. Now, in the past couple of months and pretty much since the Fed first started raising interest rates in this tightening cycle, back in March of last year, they've had this phrase, the FOMC anticipates that ongoing increases in the target range, is going to be appropriate in order for basically, rates to reach a sufficiently restrictive level, and then, which will help bring inflation back down to 2%. And so the big speculation ahead of this meeting is, what do they do with that language? Now that we're kind of nearing the end point, do they remove ongoing altogether? Do they change it to further tightening or additional increases? There's a couple of variations that have been thrown around. But I think the real question is, do they want to change the language at a moment in time when they're not quite sure, how much more to do? Because if they prematurely change the language, it could kick off another round of, easing financial conditions, which is something that, they're obviously keeping a close eye on. And it could, signal too early, perhaps, that they're readying for a pause. But if they don't change the language, I think some people are going to say, well, this statement feels a little bit stale. It's not reflecting the fact that, we've had significant progress in the data over the coming months. So it'll be interesting to see how, the Fed squares these two things. One way they could do it is to change that language about ongoing increases, but include something in there about the very high bar for rate cuts. So they could do that by saying, rates need to be held at a sufficiently restrictive level for some time, which is what we've heard from Fed officials, quite frequently and across the dovish, hawkish spectrum, basically, in the past couple months or so. So those are just a couple of things that are top of mind. I think what's important to note is in the dot plot back in December, only 2 of the 19 officials had, rates topping out below 5%. 17, so the vast majority of the committee was of the view that it was going to have to surpass 5%. And in the intermeeting period, we haven't really heard much of a divergence in those views from officials. So I think that if, in the intermeeting period, we had heard someone like Governor Waller or someone like, President Bullard, some of these, more hawkish leaning officials talking a little bit more about, the need to slow or to consider lags in the policy changes and things like that, then I think it would have tipped the hand a little bit to there being a more substantive shift in the statement. Now, that's not to say that, they don't acknowledge the fact that there's been progress. Governor Waller had one of the most notable speeches of the intermeeting period right before the blackout, actually, on that Friday. And he said, he made the case for cautious optimism about, what's been going on in the economic data. So they're acknowledging that things are a little bit different and they don't have to perhaps be as aggressive in their posture. But I think the thing that I hear most often is that, they need to do this in a really kind of thoughtful way, because if they tip their hand too early to signal a pause at a time when financial market participants are already kind of questioning how much further they're going to raise interest rates. If you look at Fed funds futures pricing, we see that the terminal rate is wagered to top out below 5%, and there's going to be 2 cuts by year end, or 50 basis points worth of cuts rather by year end. That's directly at odds with what Fed officials have said. So at a moment where there is this divergence, where they're clearly concerned about financial conditions easing, where the data, is still not telling this cohesive story, I think that there is this sentiment among people that I speak to that it's just premature to make any substantive change at this stage. Now, as I mentioned, there are ways to kind of thread the needle and acknowledge the fact that they're kind of nearing the end here, but it's really kind of a toss-up as to whether or not they want to open that can of worms, basically at a moment when financial conditions are already easing. And the reason why they're so fixated on financial conditions is because it's critical to the transmission of their monetary policy. So we heard this from Chair Powell back at the December press conference. He says it's important that financial conditions, reflect the policy restraint that the Fed is putting into place. We heard this in the December minutes of the minutes from the December meeting, where officials talked about, being concerned about an unwarranted easing of financial conditions, and one that reflects, a misperception about the Fed's reaction function. And I've spoken to, several former officials, including, Dennis Lockhart of the Atlanta Fed, Don Cohn, the former vice chair. And all of them say that, a critical component of the way in which the Fed, gets the economic outcome it's striving for is for, financial markets and to be aligned with kind of, where they think policy is going to go. So, that taking that all together, it kind of seems as though it might be premature to make any, real adjustments to the statement. But again, there's a lot of, good points on either end of that. Well, I think it has to be asked whether it's by me or not, but I think it will be. And that's just because, the Fed has highlighted this as an important, tool for them in terms of making sure, that they're on the way to getting inflation back down to 2%. So at this point, if in December they're talking about an unwarranted easing of financial conditions, well, financial conditions have only loosened more since that point. So if they're worried about it in December, it only is natural that, there would be some concern that level of, attention on these moves, increases as well. I think one important caveat is that the Fed typically pays closest attention to mortgage rates. Those have, perhaps not fallen as significantly, or have the descent, I guess, in mortgage rates has not been as quick and of such a great magnitude as, let's say, the rally in some risky assets or the narrowing of credit spreads and things like that. But at the end of the day, you look at mortgage rates and they're about a full percentage point lower than they were in the fall. And that's not something necessarily the Fed really wants to see if they're trying to, tame demand, especially in the housing sector. And if you look at kind of new home sales and things like that, economists that follow this, they say, it looks like they kind of bottomed out at the end of the year and they're starting to kind of firm a little bit. And that's not perhaps necessarily something you want to see if the overall, direction of travel you want inflation to go is down.